traders, welcome out to your trading room as we prepare for the week ahead going into May 13th through the 17th. Corey here with you, and it's always fun. Let's get to it. So we're going to take a look at the meaningful news in the markets. We're going to look at sector rotations, some interesting happenings there, where the money is rotating towards and where it's going out of. And then as always, we're going to highlight some new trade ideas, be they bullish, bearish, or neutral. And we have a little bit of a mix of all of the above for you here this week.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
So it was really a robust week. We had a huge rally across the board in equities, and it really wasn't spurred on by fundamentals. There wasn't a big news announcement. The Fed didn't initiate some big program, but it's just that recovery. And I did the trading room exactly 2 weeks ago, and I was probably surprisingly bullish to many of you. I talked about that fake out move to the downside. I just really thought that we would spike back above the moving averages, and then it would be kind of this muddy market where it's not so clear, it's not so obvious. You don't just trend lower and lower and lower. That usually, even if you are creating a long-term top, there's usually a rounded shape to it. So we'll look at that more, but it's an impressive rally. We talked about the VIX at the time had really signaled that the market had bottomed out. And now where do we find ourselves? Well, we've had this big bounce, this huge rally. We're just off of the all-time highs, and the question everyone's asking is, well, do we take off to new all-time highs? Is the correction over and it's just up and away? Or do we back and fill? Are we still moving into a more bearish market? I'm going to give you my opinion on how I think the state of things will go. Of course, we try to keep emotion out of it and try to just look at the charts, look at the data, look at the information, and follow trends as best we can. And sometimes it is trendless, and that's kind of the environment, is we have a mixed bag. We've got to sift through this muddy picture and make a clearer sense of what's happening and create opportunities accordingly. So in the commodity space, precious metals are strong. Energy, a little bit mixed results. Oil's actually lagging where nat gas and some other energies have rallied. But for the most part, those have gone with equities and gone higher. Bonds have also rebounded. And if you look at the bottom in bonds, if you are looking at U.S. government bonds, you can use TLT or IEF. Those are ETFs that show you a 10-year bond or a 20-plus year bond. And you can see that they're somewhat correlated with equities, that when bonds bottomed, you also had more of a bottoming in stocks. And it's really not about the bond price, it's about the yield, right? When bonds bottom, that means yields topped out and yields have backed up. And the equity market wants to see lower yields. They want to see that basically bonds are pricing in that inflation has been beaten, that the Fed is not going to raise rates, that we've hit the top of the cycle in yields, and that things are going to back up from there. So equities like the fact that yields didn't continue to spike higher, that they topped out and they've backed up a bit, aka bond prices have bottomed and rallied. Remember, bond prices and yields move in opposite directions. So as we look at this past week, there really wasn't much. I mean, if we look at here in the U.S., consumer sentiment on Friday, big miss, but that's not a big impactful number. And even with that, equities still started the day and finished okay. So there just wasn't a lot here in the U.S. economically or fundamentally to do anything. So the markets just traded on technicals this past week. And since we had broken out above those moving averages, no huge surprise that we had some strong performance. So as we look at this week, Dow up over 2%, S&P, NASDAQ up around 1.5 to approaching 2. Russell 2000 lagged at plus 1%. Oil flat, gold up 3, and that again speaks to, I talked about that oil's kind of lagged, oil's still in more of a downtrend, and of course that's the most important thing for the energy sector, so that's worth noting. As we look at the rest of things, here's what I see in terms of the chart. So I said it at the time, I really thought this was an important day. And, similar to how this was an important day. And if you look at price action, it's sort of, I'll know it when I see it. I'll know that there was something significant when I see it, and I'll get used to identifying, hey, that was important. What happened there was a signal. It was something that shows that this group lost control and the other group took control, that this group doesn't have as much strength or doesn't have as much weakness as one would have expected. And just as we tried to gap higher back here and then failed, you see how we gapped up but then finished very poorly and it led to further declines. Here you had sort of the opposite. We gapped sharply lower, we sold off, but look at the big recovery. So in both cases, you gapped one way, but you finished very much in the opposite direction. And the reason I thought that was important was not just the gap and then the recovery, it was more about the fact that we didn't continue the downtrend. That basically, if this was going to be a clean, bearish market, we were just simply going to have a nice rally, and then this rolls over and we keep falling to the downside. And we move away from these moving averages and we give these moving averages time to continue to downward slope and so forth. That's what happens in a bearish trend is supply, selling pressure comes in and aggressively hits the market. You have to have more sellers than buyers. You have to have the sellers as the aggressive party. You have to push prices lower, and that in turn brings about more sellers. But that's not what happened. Prices went lower and the buyers stepped up. And it was an important day in terms of telling us that, look, it's going to get muddy. It's going to get ugly. It's going to get choppy. It just wasn't the bearish environment that it would have, could have, should have been. And that was really confirmed more than anything the very next day on the gap up. So did we get muddy? Yeah, we chopped around. The Fed kind of pushed us down, then we spiked back up. But notice the difference here. You gapped up and you stayed up. And then the follow through and the more upside and so forth. So from this point, I mean, just as I did the trading room 2 weeks ago, I was bullish from that point in that in the short term, I thought we'd get back above the moving averages. In the long term, I'm not so sure we have a lot more upside. It wouldn't be shocking if you kind of poked your head to a new high. Sometimes the best moves are the fake out moves, right? From false moves come fast moves. So just as this was a false gap higher and then things really sped up to the downside, this was a false gap lower and things have sped up to the upside. Maybe the top here is just a little false move above the highs here. You spike above for a day or two and then you sharply come back underneath or something like that. Give us some indication. Maybe it's a big gap up that can't hold or whatever. I would be looking for some sort of false directional move, some sort of failure on the part of buyers to keep pushing higher. Because remember, there's constantly this battle that exists between buyers and sellers, and we need to know who has control and where it's coming from and so forth. And just as this showed us that the selling pressure just wasn't going to be there, and it was confirmed with this huge, ugly, bearish reversal in the VIX. Remember, the VIX is really a fear gauge. It's a measurement of how much volatility is priced into the market, and one would expect that if we're going to continue in a downtrend, the VIX would keep going up. But the VIX didn't do that. It had these big, ugly, bearish reversals right here. And again, as the VIX started to plummet off the highs, a signal that there just was not going to be that selling pressure come in. So watch for the inverse of that. Big up day in the VIX, big bearish reversal in the market. Something like that would get me more interested in the short side. So what do you do from here? It's just tough. I mean, I can't really pound the table and say, hey, you should continue to buy or you should short it here. My best guess is that fast forward a couple of weeks and we'll probably be in the same general price range. And ultimately, I do suspect, I would lean towards thinking that we're going to move and further progress into a downtrend. Now, I touched on this a little bit. If we go to the NASDAQ chart, if you look back to market bottoms, they're usually V-shaped. And there's reasons behind that, but when I say V-shaped, it's like if you just can't catch it. It's there and then it's gone, and it's like a blink of an eye type thing. Whereas market tops are usually much more drawn out and much more rounded shape. It's like, catching the top is more of you're in this general zone for a while and it just rolls over and so forth. And it speaks to the behavioral aspect of markets. One is that markets always have more potential buyers than sellers if we think about it. First of all, there's just more and more money being printed, right? There's people have automated funding that goes into their IRA and their 401k. There's always this influx of capital. So in order to get a market to turn down and to sustain down, you need to convince a lot of the old buyers to become sellers, and maybe the buyers that want to buy, maybe they stop buying and so forth. You have to have this bigger transition. And the buyers don't go away easily, and that's why usually there's more of a rounded shape to it. And so if we were to look at the NASDAQ or the S&P chart, you're kind of taking that rounded shape where are we at the highs? Maybe so. I would kind of think so, that we're setting sort of the precursor to a bear market that could emerge later this year and so forth. And this is very characteristic of what often happens. So the same way that a bear market will finish with just a violent V shape, usually bull markets end in sort of a rounded shape. And then the selling intensifies when you get down here. I mean, if you're looking for big, huge drops that just keep cascading lower, it happens more late in the cycle, not early. I mean, here we dropped. It was a nice drop, but we recovered that back within a few days. And it just wasn't, again, it very much speaks to what I've been emphasizing, which is if you're expecting some intense selling that just keeps going and going and going, that's going to be way down here. That's the reason it happens late in the cycle is because, again, think about supply and demand. In order for there to just be violent, crazy, wild selling, there has to be a catalyst bad enough to get that to happen. A, to scare people into stop buying. B, to scare people into selling shares. C, to basically force liquidate. So margin clerks, if you're a broker at Interactive Brokers or Thinkorswim or wherever, well, when the market goes down 4 or 5%, you're not massively liquidating client accounts, right? People aren't in a world of trouble. But when markets are down 15% and people have been leveraged up, well, you're going to get some forced liquidations. And that's what happens here later on. So if you're expecting the intense selling, again, that's still down the road. Don't expect that in the near term as the likely outcome. So will you get some sharp selling days or little periods where you have a nice run? Sure, but that's kind of more normalized, run of the mill. It's nothing out of the ordinary. And again, a lot of that has to do with the behavioral aspect of why people buy and sell and where they do that. If we look at the heat map for the week, Tesla had a rough week, Disney, Airbnb. I mean, there's some areas of weakness, but overall, certainly more in the green. And if we look at this, financials had a stellar week. That's pretty much in the green with the exception of PayPal. Utilities had a fantastic week. We'll touch on that more. Healthcare, a little bit mixed in here, tech, a little bit of a mixed picture. Intel and Uber, and there's some pockets of red, there's some pockets of green, but overall, certainly more green than anything else. So, my outlook: are we pause for this big surge to new all-time highs, and the bull market reemerges and we take off? I would not be leaning that way. I think it's still a mixed picture. I mean, we've got 20 period moving averages that recently crossed the 50, and now we're back above them, and it's just kind of chaos in here. I've called it a muddy, kind of murky market, but when you have that, if you were to say to someone, hey, we're going to go into a range and it's just going to get choppy and back and forth, the playbook changes, the mentality changes a little bit. From in trend trading, we just follow the trend and we try to buy dips in an uptrend and just keep running it higher and higher and higher. In a downtrend, you sell the rallies and you just keep playing it lower and lower. In a sideways range, you really do the opposite. Like when it gets really strong, that's when you sell. And when it gets really weak, that's when you buy, if you're in this more mixed picture. So I think we're keying up and a little bit closer to a short-term top than obviously the bottom. And that's what Friday kind of felt like to me, was a nice rally that punctuated the end of the move. We do have option expiration Friday this coming week, the next week. It's not as pronounced and significant as it used to be. We used to only trade monthly options. There weren't even weeklies available. Weeklies have been around for years now, and so it's taken away some of the luster of the third Friday monthly expiration, but it's still far more impactful than an average weekly expiration. So we get kind of through this week, and then I suspect and wonder if there's not another leg lower. Bond yields seem to be key to this market. As long as yields are, not going significantly higher, equities can do okay and remain in this chop. If for some reason we started to see the bond market tank and yields spike up sharply, the 10-year started to get above 4.66 and those levels, that would be a problem. First quarter earnings are winding down. We know that when we get into the retail space, so the Walmarts, Home Depots, Deere, Applied Material, that they're not all retailers. Baba, that's the biggest retailer in China and so forth. It's when you start getting into the retail part of earnings and retail companies, that's usually when you're in the back end of the earnings season. So next week, we do have more economic reports, more impact than what we had this past week. We get some PPI numbers, and we get Fed Chair Powell speaking on Tuesday. We get some CPI numbers and some retail sales on Wednesday, and we get some, well, we always have jobless claims on Thursday, but obviously CPI, Fed Chair Powell speaking, I mean, these are big things. Now, the inflation gauge here is expected to tick down just slightly from 3.5 to 3.4. Remember, the Fed's target is 2%. So at 3.5, I mean, you're still way too high on the inflation reading. A month over month number coming in at 0.4 is not really good news either. Remember, this is monthly, and then of course you multiply that by 12. If we were to have 0.4% per month for 12 months, that would annualize at a 4.8% annualized inflation rate. So not great from that standpoint either. So something to, kind of be aware of, and that I don't know that the inflation numbers are really great news. Even if they came in at 0.3, it would just be too high for what the Fed is looking for. Now, market outlook, I went with kind of a -1. Obviously, mixed picture. I mean, the 20 is starting to turn back up maybe, or flattening out. The 50 is still kind of flattish. Price has gone back above after being below, but we're in this kind of murky market, and maybe a little bit of a triangle range bound type of trade could persist from here. Now let's go into some sectors. You're going to see the same thing essentially as we look at all these different sectors. There's good more than there is bad. There's certainly more sectors in what I would consider a +1 or better versus a -1 or worse. So as we look at the sector performance, utilities had a great week, +4%, financials up 3. Really everything was solid except for consumer, which was exactly flat. So consumer, energy, and tech seem like the biggest laggards. Now, if we go in and look at these sectors individually, utilities have been on a run. If there's one sector that I don't trade more than anything else, it's utilities. I'm just not a big utility sector trader. But having said that, it is strong, and we've highlighted that. I went back and looked at my trading room from 2 weeks ago, and it was the strongest sector, and we highlighted it as the strongest sector at that point in time. So it's getting a little bit more long in the tooth, but certainly it is bullish. If we look at communication services, back above the moving averages, but again, moving averages kind of crossed up. I'll give it a +1. I kind of +1 to neutral is sort of what that chart looks like. Real estate, here you've got more reason to be bearish. You're still below the 50-period moving average. You're still in more of downward slope on across both of those moving averages. So real estate, although it's gone on a nice run for a couple of weeks here, it really doesn't look that good. By comparison to other sectors, uh, real estate's worth a look for some shorts. Healthcare got back above the 50. We got to give it a little bit of credit there, but it still doesn't look convincing to me. I would call this a -1 to a 0-ish. Again, I'm looking at things like the slope of the 50 in addition to the 20. Some of these have a little bit more pronounced downward moves. And so I'm, looking at this as relative weakness compared to other sectors. It just continues to underperform. Let's go to industrials. Clearly much better. Look at the slope. Look at where we're at in comparison. Look at the fact that we're maybe going to touch a new high before anything else. So the industrial sector, pretty solid. If you were looking for an area to buy the dip, if you felt like, hey, I want to buy on the next pullback, this would be a sector that I would have some interest in. Financials also look very good to me. Similar to the industrial space, financials right up there. Maybe not quite as close to the prior highs, but pretty darn close, and would be a sector that we would have to consider. Consumer, we talked about this, lagged all week long, flat, and again, downward slope, even finished closing below the 50. I don't like how the consumer sector looks. That can change, but it probably won't change dramatically. Even if it starts to rally, I would just expect it to underperform. Even if the market were to pull up everything, it just doesn't look like it's in a great place. So consumer names, still more on the bearish side. Technology, this is similar to me to healthcare. I'm going to give it more of a negative reading. I mean, essentially, we're still in more of a downward trend. Yes, we just got above the 50 a little bit, but not real convincing. It certainly didn't break out to the upside. It didn't surge on volume or anything like that. Just looks like one day below and you got a little fake out type of scenario where it looked like we might be trying to cross and then we come right back in. Tech, to me, I suspect will underperform here for a while. That's the way it looks to my eye. Materials, I'd give them more of a bullish look. Again, just better slope in the moving averages, better. We've already crossed. When we crossed above, volume characteristics and things look better. So materials a little bit stronger at +1. And then energy, this is a 0 if I've ever seen it. We're stuck right in between a downward slope and an upward sloping moving average. We've got this wedging type of pattern. Now, this is a 0 that can become something significant. This is a candidate. I don't trade a lot of long straddle, long strangle type of trades, but if you were to look at a risk graph of a long straddle or something along those lines, so here's your break-even point, And in a long straddle, you're basically buying the call and buying the put. And you're saying, I don't know which way it's going to go, but I expect the volatility, the move, to be bigger than the market's anticipating. And so this is what we would call a volatility compression. It just gets compressed down and it's like, you know, kind of wound into this tight formation where ultimately it needs to break out. It kind of reminds me of that Jack in the Box, that dun da dun da 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 dun, and you're just not sure when it's going to break out or even which way it's going to go. It could break sharply higher or lower, but it could even possibly be a candidate for that. Right now, I just don't know how we would make a strong opinion one way or the other. So this is how I have them broken down. Again, a little bit more bullishness than bearishness. But interestingly enough, the more convincing charts seem to be on the downside, of lagging, of underperforming, and just not keeping up, if anything else. So with that in mind, let's go highlight a few possible ideas. I start with the utility sector, and I mentioned I don't trade this sector a lot, but here's PCNG. If we look at possible trades, this one's a little bit weird in that it's bullish, so I'm looking at a diagonal call spread, but I'm putting my May 1750 call below the current price. So here is the strike, and the stock's above it. So what that does, I mean, if we bought the June 16 call and sold the May 1750, we're basically in a diagonal spread, but our target is just a little bit lower over the next week. So what would be ideal would actually be the stock pulling back, and then we'd own the June 16th calls outright for the next bounce and the next recovery, and we could go from there. It is kind of a strange trade in that you're trading a call spread, but you're actually targeting a minor pullback as the ideal point for this stock to finish at expiration. So as we line that up with the chart, you'd really have to say, well, our outlook is that we get a little pullback back towards about 1750, and that would be picturesque for the idea. So it would be bullish long term, but I guess bearish in the very near term in that we'd want to pull back. Let's look at the financial sector. Here's Berkshire Hathaway. It's kind of been a personal preference stock for many months past. You can see a little double bottom type of dynamic. And if that's a double bottom, here's the neckline, and there's the break above it. This is a case where I think what's going to transpire over time is that this is going to get back up here towards those prior highs. So a cup, maybe a handle in the future, something along those lines. What I'm looking for, though, is for this to continue to work its way towards that 424 target. So I'm not being super aggressive, but I am being aggressive in that I would be targeting a call spread up here, expecting the stock to go from 415 and finish above 420 by May 31st expiration. Now this gives you an excellent risk to reward. If we were to look at it on a risk graph, when I was looking at this, I want to say that the trade was going for around a $1.80 debit. So if it's going for a $1.80 debit, and it might have been a $1.85, I don't remember the exacts, but it was somewhere in that neighborhood. Well, if we trade a $5 spread and we pay a $1.80, that leaves us $3.20 of potential reward. So we've got $320 max reward. We've got $180 of max risk. So good risk to reward. And then the way that this structure works is it's a bull call spread where if this stock gets to 420 or higher, we make 320 bucks. If it finishes at 415 or lower, we would lose 180 bucks. And so we would structure it in that type of way in terms of a bull call spread. Kind of an interesting idea, I think, for Berkshire, where it has broken out of the double bottom broken out of this range, and I think by May 31st, by the end of May, we could be up there above that 420 level. Last but not least, the technology sector. Here's Intel, and Intel is just in sort of that death spiral. It's been low basing down here, and I suspect probably a bit lower. Now, in this particular trade, we were looking at a May 31st expiration, and we were looking at the 29.28 bear put spread. Now, when I was looking at this, the cost on it was around 20 cents, which first of all tells you it's not a high probability that we could get to 28 or lower by May 31st. But if we did, we'd have 80 cents of reward. So we got $80 of reward for $20 of risk. That's a 4-to-1 reward to risk ratio. Nice reward to risk ratio. And then if we look at the risk graph and draw it out, here's your break even. You would need to be at 28 or lower for max gain. You would need to be at 29 or higher to take max loss. And your max loss is 20 bucks. And your max reward is up here at 80 bucks, 4 times higher if you get to $28 per share or lower. So your risk graph looks something like that. I kind of messed it up a little bit, just shade it in there, and it looks like that. Where above 29, well, we're going to lose our $20 per spread trade. But if we can get to 28 or lower, we got 80 bucks a reward. Now, I don't know, again, the market's saying there probably won't be that much volatility, but I thought it was an interesting risk to reward, and it wouldn't shock me if some of the selling that hits the technology sector is a little bit harder than in some other sectors, and that Intel can potentially have that type of decline. So interesting type of structure there. In conclusion, market signals are mixed. Technicals, we'd have to give the benefit of the doubt a little bit to the buyers. It's not like it's a runaway bull market, but we want to keep emotion out of it. We want to just trade what's in front of us and trade the opportunities. And look, it is a little bit more bullish than bearish. Continue to focus on the best opportunities. So have a great weekend, everyone, and we'll see you next time. Goodbye.